Hey traders, Stephen here. It's tradersplan.com. It is Thursday morning, November the 1st. I hope everybody had a happy Halloween with their kids and getting candy or passing out candy. It's all fun. So let's get right into it. We are in a market correction. I have a lot I want to cover today as usual. We're going to look at the charts. We're going to look at some seasonality today. We are entering a historically bullish period of the year, kind of that last 6 weeks of the year. So we're going to look at that in the Nasdaq and of the individual sectors, what sectors tend to outperform towards the latter. So we'll take a look at that. Let's start with the Nasdaq chart. So, you know, what I did differently is one, the Nasdaq from peak to the bottom of, I'm guessing that was Monday's low was a 15% drawdown. That's a pretty good drawdown. So what we're looking for, right, is you have a failed support break right here, a bounce back. You haven't really got a bounce. We're trying to bounce again right here. So I did throw a retracement on here because right in this zone for a counter trend bounce is a 61.8 retracement, like right in here. So I'm very interested to see how the market reacts in this zone, if it can punch through it. There's plenty of evidence looking at past corrections that even if we do get a counter trend rally, and they can be strong, and sometimes it's hard to just watch it go by. Trust me, I know the worst thing is watching a big winner go on without you or watching the market go on without you. That's typically the most toughest for me. Okay, so we're just going to kind of continue to watch this zone again, to take it day by day and just make sure you have your rules in place. Right now, I think we're about 6% off this bottom. So if you take a stab right here, even a directional ETF, you're going to have to risk 6% to the downside. So we'll kind of see how this day goes. It started strong, and again, if I could just tell you one rule during these corrections, however you put your money to work, try to put your new buys to work towards the end of the day, because you don't want a market to stay strong and finish weak. On Monday, I decided against buying at the open, even though it was strong, because I wanted to make sure the market would stay strong. And by the end of Monday, boy, it just sold off. And I mean, I was looking pretty smart at that point in time, but I mean, it's just the simple rules that over time that you need to put in place, and now the market is bouncing, which is fine, but we are entering kind of a critical area. And just kind of keep in mind that, looking at the international ETFs that are already in bear markets and everything else, and they've just been zigzagging their way down. They've been bouncing and then hitting a trend line and continuing their downward trend. Is the S&P 500 going to look like that? I don't know. Or the Nasdaq. Let's look at the S&P 500 weekly chart. No, that's not it. SPX. Oversold. Okay. So this is a 10-year chart of the S&P 500. This is a weekly chart. Now, I just kind of wanted to put things into perspective. If you can kind of see this right here, this over here, if I blow this up, might be a little blurry. We are having a reversal in the market, positive, okay? The week isn't over yet. The daily chart looks, I think, uglier, but on the weekly chart, we do have a reversal in the market. But I do want to show you something. So let's go back and look at all the past corrections. Now, I'm not going to analyze 2008 because that wasn't a correction. That was a full-blown bear market. But you had the correction. I have the RSI 5 down here. And again, this is a weekly chart, okay? So you have the RSI 5 down here. And, as it was going down, it went into oversold. That oversold is under 30, okay? And then it tried to bounce, and then it took a double dip. So I have these purple horizontal lines. These are the double dips in the oversold. And then it came out of the correction, okay? So the 2010 correction took a double dip oversold on the RSI 5 weekly chart. Same thing in 2011. You had the initial sell-off, right? Came back, probably sucked everybody in, double dip. It came all the way back down into the oversold zone, And then the interesting thing about the 2011 correction was coming out of the bottom of this second leg of oversold wasn't even the bottom. It came back and then created a weekly reversal in the index. And it wasn't an oversold, and this was the low. The reversal was the low, and it didn't go into oversold. So that was a positive divergence, letting people know that it did something different. The two previous dips were oversold. The third one, even though it undercut the previous two legs, did not get oversold, giving you a little bit more confidence. So my point is, when you're getting in these corrections, you're going to have a couple of shakeouts, and the bounce back rallies are going to be strong. And I'm not telling you not to play them. All I'm telling you is to sell a little bit of profit into strength, and, you know, have a kind of raise your stop along with it in case it rolls back over. Now all of these other oversolds, these are all pullbacks. These are not corrections, these are pullbacks. So then you have the 2015, early 2016 correction. It doesn't take a genius to spot the double bottom here. But look, multiple oversolds, even though it came all the way back to overbought. So on these two corrections, you can see the double dips, there is no overbought in the middle, came close. But on this one, it went oversold, overbought, oversold again. So it can really, and it really sucked everybody back in. And I remember this was looking really, really strong. And then it started to create a bull flag, and then it just failed, rolled back over into oversold. So now here we are in another correction. Let me take a sip of coffee. So here we are in another correction. And we've got the first leg. And based on the three correction, the previous three, it's not a guarantee. But based on the previous three corrections, we probably should, or based on the three more serious corrections, we had some pretty serious legs down earlier this year, but it never reached that kind of oversold in the correction territory. If history is a guide, which normally it is, we'll probably get a counter trend rally and then take another dip into oversold. So just be cautious is all I'm telling you. The 10-week, so the death cross in the S&P 500 is closer to the 40-week moving average than you think. And that's bear market all day. So you can see the blue line right here, the 10-week, that's above the red line. You're in bear market or bull market. When it crosses under, you get that death cross, that's a bear market. Then you should really, really take protective measures. So, you know, I'm trying to help you navigate this market a little bit. Let's look at bonds for a second. Okay, so what's interesting right here is you have the TLT, you have a double bottom, right? Thinking it's going to be good. False breakout, which is above average move to the opposite direction. Learn that from Martin Pring. Martin Pring from Stock Charts always says, if you have a false breakout or a false breakdown, one way or the other, typically that's an above average move in the opposite direction. Well, not only did the bonds come down, it undercut this double bottom right here. It started to bounce off, and I thought it was going to break out, and then you have another kind of false breakout of this little mini pivot right here, and it's coming back down. So again, I'm always trying to preach what you think conservative sometimes are not so conservative. Yes, bonds don't move as much as stocks. I understand that. But, and I'm not telling you to not have a diversified portfolio, but you need to be aware that bonds can go down too in a bad market. Typically bonds go down first and they bottom first. So when a bond, in a major bear market, typically a bond, according to John Murphy, a bond, and I've seen his charts, bonds will sell off first, and then stocks could sell off later. You know, it could be a year, it could be a couple months, and then bonds will bottom first in a bear market. So I'm not saying we're in a bear market, but bonds topped all the way down here. Which makes sense in that secular rising interest rate. Typically when interest rates rise, you're trying to cool off the economy. Either way, let's just keep our eyes on the charts, right? All that fundamentals, you know, just keep your eye on the chart. What is the chart telling you? That bonds are incredibly weak right now. So on the flip side of that, the US dollar is incredibly strong. There's nothing to say other than that the dollar is in an uptrend. It's made a big move, right? It broke out of this inverse head and shoulders, and then it pulled back, kind of false break to the downside, cup with handle breakout. So, you know, I don't really always like drawing too many price targets, but the old saying goes that, you know, the measured move in that is going to be the measured move in the opposite direction once it breaks out. So if that is correct, what that is telling me, if that's, let's just call it, you know, 6.75%, that's saying that the dollar should move quite a bit. Let's somewhere up in this area. I don't know if it's going to get all the way up there. That is the measured move. If you measure, you know, the neckline to the bottom of the head, or vice versa, that's the move in the opposite direction. But it is looking pretty strong. So, you know, the dollar continues to outperform. Now, typically when dollars outperform, your S&P, your U.S. stocks are going to outperform the international stocks. So international stocks are by far in a bear market. They've been in a bear market. Their death crosses have happened. They're down 20% or more. So S&P is, the U.S. is still the strongest place to be. Now, before we look at seasonality, let's look at a little bit of breath. Okay, so S&P breath right here. So you have 41% of stocks in the S&P 500 above the 200-day moving average. 28% above the 50-day moving average, which makes sense. And 35% above the 20-day moving average. And why that is because a lot of the 20-day moving averages have curled under the 50-day moving averages. So the 20-day moving averages are kind of the first hurdle since we're in a downtrend. So this makes a lot of sense right here because a lot of the growth stocks I've seen, they just are not in a, they're not above their 50-day moving average. They're in major corrective territory. Growth stocks are going to be down 2 to 3 times what the overall market is. So just keep that in mind. That's why you always want to have a plan for growth stocks. And when you're in a strong trending growth stock, I think the best thing to do is just use the 50-day moving average. If it breaks the 50-day moving average, unless you're double or triple, my opinion, you should be out. Or at least I'm going to be out. It's really just as simple as that. If we go look at the overall indices, percent of stocks above the 20-day EMA, you have technology, 37%, financials, 38%, consumer discretionary, 50, almost 50, so that's the strongest. They're bouncing back, that's good. Industrial, 16. Healthcare has not really bounced back as strong as 23. That's your biotechs, your healthcare, your medical products. XLP, which is your consumer staples, your defensive plays, they are the strongest. XLE, energy is weak at 6%. XLB, materials, is also weak at 34%. And then XLU, which is your utilities. So you have your utilities and your staples the strongest. It's not a surprise. And then right here you have your discretionary. So you have one sector that is showing strong. Probably has to do with some earnings that are moving these up. So, you know, just looking at the evidence, that's not really something that you just want to be cautious, right? That's just showing you that not even half of all the most aggressive sectors, or out of all 6 of the aggressive sectors, 6 or 7, not a single one is 50% trending above the 200 or the 20-day moving average. So that just might go to tell you something. But let's look at some seasonality. I do want to look at SPX. We'll start with XPX and then we'll go to seasonality. Because I think that's important. You know, you don't want to paint too big of a bearish picture. I try to be a bull. So over the last 20 years, you can see that November and December are some of the strongest months for the S&P 500. 74% of the time in the last 20 years, the S&P 500 has closed higher with an average gain of 1.1 and 1.2%. You can see that the S&P 500 September has been the weakest. So we're entering a strong month. So it's important, even though I'm showing you some bearish evidence, it's important to understand that there is window dressing towards the end of the year, that we could come out of this, but we'll just have to wait and see. Let's look at the Nasdaq. Go. Kind of go back 20 years. So you can say it is clear to me that November Nasdaq is the strongest month of the year for the Nasdaq. Well, excuse me, it's not the strongest month, but it is the month that gives you the greatest probability of having closing higher. 74% of the time, closing higher at an average gain of 1.5%. Now, October is typically stronger at a gain of 2.4%, but only 65% of the time. So, you know, I don't put too much stock into this. I follow the price action, but, you know, seasonality is important to pay attention to. If you do get a buy signal, I think it's important that you take some action on it, right? Just based on the seasonality factor. So we have to keep this in mind. Now, if we were to, you know, throw some more aggressive, let's just throw some individual sectors. So you got the XLF, the financials. You can see right here. Typically the October, December, this kind of end of the month for end of the year for financials is typically strong. December is the strongest month. 74% of the time it ends up with a gain. So that's good odds right there. And again, we're playing the odds. Now let's compare it to XLK, which is technology. Let's just see what this looks like. So percentage of months, XLF financials outperformed XLK. So 68% of the time in December. That doesn't mean that XLK has a bad month in December. It just means that XLF is outperforming technology 68% of the time in the month of December. Okay? Let's just look at XLK over here. Kind of get rid of this comparison chart and look, because again, if we're heading into an aggressive time of year, we want to make sure we keep our focus on that. So you can see right here that 74% of the time technology is higher. Okay? So we could get a bounce, we could get a rally, but November is the strongest month for technology. Let's look at consumer discretionary. And again, I'm trying to focus on the more aggressive sectors. Discretionary. Oh, look at that. There is a steady rise from October to November to December. 79% of the time, discretionary stocks are close higher in the month of December. I am not telling you to go out and buy with abandonment, but I'm just stating the facts. Over the last 20 years, this is what we're looking at. Let's look at healthcare, because healthcare has been kind of a star this year. Also entering a strong multi-month over the average of last 20 years. Healthcare up 74% each of the times, with an average of 1.5% gain and an average of 2% gain. So let's look at something a little bit more conservative, like XLU, utilities. Utilities, 53% of the time in November, 63%. So not as strong as the more aggressive sectors. So I've given you plenty of evidence for the bearish case, but from a seasonality standpoint, I'm giving you plenty of evidence for the bullish case. Now always pay attention to the price and volume. Do not let seasonality override what the price and volume is telling you. But if you start to get buy signals, this seasonality is just kind of one more reference point that you can use as a vote of confidence, saying, hey, normally this time of year, institutions try to do a little window dressing and make their accounts look all pretty. Maybe I should ride their coattail. let's look at XLP. Let's look at the defense. Okay, so you can see that it is strong in October and November, but it does taper off, and that makes sense because people are getting rid of their defensive stocks and they're getting rid of their staples and they're buying the discretionary. So if we go back to XLY, we're looking at staples versus discretionary. So what this is telling me is only 42% of the time staples beat discretionary stocks more aggressive in November and December. Only 42%. I'll take these odds. So all I'm saying is don't get too bearish. Don't fall asleep at the wheel. Right now there are plenty of signs that are showing that we could get a counter trend rally, but don't get too far sucked in. Take profits along the way. This is part of the trade plan. You want to take profits along the way. If you're not sure what to do, raise your stop. Once it crosses the moving averages, use a moving average as a stop. If it starts to roll back over and takes that second leg down, we are trying to put ourselves in a position to win. So what I'm finding is most stocks right now are still haven't even started to form. Most growth stocks have not even started to form the right side of the base. And just let me show you kind of an example. Let me just show you Wingstop. Wingstop, I think, has been a leader up until probably until it reported right there, right? So, but what happens is when you have a leading stock, and let's say you got a gap up right here, and then it starts to consolidate. Typically what it'll do is it'll bounce real quick, and then it'll come back and kind of build that right side of the base. I'm noticing, and then you get your breakout, right? But typically in something like that, you don't want to wait till it gets all the way up here. You want to kind of try to buy this breakout down here, although this kind of gapped out of it. But I'm typically, looking to buy something like this. But what I notice, a lot of these growth stocks, they'll start to build the base. In my opinion, they're still on this left side. They haven't even kind of tried to bounce and then come back and form that right side of the base, which has given me a little bit more evidence that this correction does need a little more time, even if we get a counter trend rally, okay? So this was a perfect example of a leader that finally broke the 50-day moving average. So in my opinion, depending on how much you own, you should have been out. And then boom, okay? I can't help myself. I just have to show Curo. And this is a case study stock that I've used over and over, and you have to have these case studies to learn from them. Bought here in the newsletter, sold into some shares in a strength, sold my remaining shares right here. It was finding support at the 50-day moving average, sold right here. I didn't know it could have bounced right back. That would have made me mad, but I could have bought it back. But I sold right here. Guess where it is? So here's what happened. It fell all the way down to the 200-day moving average. Then it reported earnings. So you could have said, well, maybe it's just a deeper correction. I'll wait till it gets down to the 200-day moving average. Then it had its earnings and just bad things happened. And what happened with this one is the delinquency rates on, because it's kind of that quick cash payday type of company, so you're dealing with a different kind of consumer, delinquency rates rise. So for days there wasn't a bid in sight. So I got out up here around 28 and some change, and it's at 14 now, below where I bought it at 17.93. So that's just why you have rules. You never know what's going to happen, but this is also evidence to show me I'm seeing a lot of growth stocks. The ones that aren't doing very well in earnings, they are getting absolutely taken out to the woodshed and beaten like they stole something. And that's what happens. You'll have like a gap down of 20%. And when I start to see a lot of these gap downs, clearly that's evidence of the kind of environment we're in. It is an unforgiving type of market. So let's just look at a few interesting stocks. I'm going to show you one that, it was unfortunate. I misplayed it. Trivago is one I've been talking about for a while. Now, I did have a trading plan. I bought in here. It moved up. I said, I'm just going to hold out for greater gains. It came down and it broke the 50-day moving average. I got out for a small gain. It's very unfortunate. And this is, you know, the Curo one worked out. This one did not work out for me because I sold it because the market was selling off and it was breaking. I didn't know how long it would go. And this is the frustration, right? This is the whipsaw. Then, like, it just comes all the way back and then some. But now, I'm not against buying this back because you have, you know, the last 2 times that it has reported earnings, you got volume right here, and now you have lots of volume right here. So there still could be a lot of opportunity. It could drift down, create a bull flag. And I'm not going to say I actually misplayed this. I had a plan. I stuck to it, and the outcome for me wasn't desirable, right? And there, I was reading a book by Ann Duke. She's one of the most famous poker players of all time. I can't think of the book. What's the name of it? It's called Thinking in Terms of Bets. And one thing she teaches, and it really stuck with me, is just because the outcome wasn't favorable doesn't mean the decision you made was wrong. So, and I agree with that completely, because you don't want to, you know, make a lot of wins from a bunch of bad decisions. You want to make good decisions, and with those good decisions, you're going to have favorable outcomes and you're going to have non-favorable outcomes, right? But just because you have a non-favorable outcome does not mean you made a bad decision, right? Because in the end, you want to be the house. And if you're making good decisions in the long run, you will be the house, okay? Because this could have done what Curo did, and then I would have been incredibly ticked off because I had a plan and I didn't stick to it. So let's look at a few stocks that are looking kind of interesting right now. Secureworks. The computer software security sector. Let's look at the fundamentals first. You know, it hasn't quite turned a profit, which a lot of them haven't. Sales are okay, but what I'm noticing over here is a rising relative strength line. Okay, a rising relative strength line when the market's selling off. You have lots of accumulation right here. You have a kind of a wild earnings day, but it held up. And when it started to correct with the overall market, it bounced right back, created a flag, and broke out yesterday on volume that was 148% above average. So this is a stock that's trying to break out, but the market is holding it back like a springboard. Not a lot of stocks are breaking out and are holding their breakout at big volume. So you could say, you know, this is one big cup with handle. This is the traditional breakout zone, whatever. It broke out during a market correction. It has a rising relative strength line. It does have some distribution days, but I would, without a doubt, you know, say that there is a lot more accumulation on the weekly chart than distribution. So this could be something to look at. Another stock that is really interesting to me is BILI. This is a Chinese stock. Now, these companies are just absolutely getting slaughtered. They're getting, you know, rightfully so. But that's not the point. Most of them are in a really, really bad shape. However, this one, BILI, it's expected to turn a profit next year. Really, really good sales growth, although it is decelerating a little bit. But here's what's interesting to me. You have an earnings pop. It is made a big move, came down, right, from 22 to $9 in a couple months, to show you how volatile these names are. But it made a pop, an earnings pop. And the market hasn't really made much headway, so it's been going sideways. You have another, it's tried to break out multiple times. You have another earnings, right, or another volume pop right here. It tried to break out right here, but just couldn't hold because the market is holding it back. And then the same thing happened yesterday, and it sold off to the close, another volume pop. So you have one distribution day, which is nothing compared to the skyscraper volume day. So you have it's a very volatile stock, a slightly rising relative strength line. It's tried to break out. You got accumulation within the base. The market is without a doubt holding this stock back, but this could be a big winner, because if something can go from 9 to 22 in 2.5 months, I mean, it's just interesting to me watching this, and it could break and go the other way. So I'm not telling you to buy it right here, but I'm just saying this I believe is being held back by the market. Not a lot of sellers, net buyers, and it's just going sideways, which is going sideways when the market's going down, because that's showing the rising relative strength line. One more stock I want to show you is FEYE. Now, let's start with the fundamentals. This looks really, really good on the weekly chart. On the weekly chart. Daily chart is choppy. So this was a former Wall Street darling, went all the way up to 100 after its IPO, started losing money, or probably always lost money. 2018 is anticipated to turn a profit. 2019's earnings are anticipated to accelerate to 138%. That's a big growth jump. Selling at a high volume, but most growth stocks are. But mutual funds are starting to pile in it. Sales growth is nothing to write home about, but look at the accumulation stepping in, right? You notice so this is just a big first stage base, right? Just a big bottom rectangle pattern. That probably didn't draw that very good, but this is a big first stage bottoming rectangle pattern. You know, you can read any book, and it's just a classic pattern. Within this, there's just a lot of chop, right? But when it starts to get tight and neat, right, in this pattern is from what I have studied, that's when it could potentially take off. So you have, all these positive earnings reports. This one moved the stock up. This one moved the stock down. This one created the bottom. And now you have another one. Lots of accumulation. Look at how wide and loose this is versus now how tight and neat this is right here, at least on the weekly chart. It is changing personalities, which means you need to start paying attention. And it popped yesterday on 400% earnings volume. It's holding the breakout. I'm not saying buy right here. I personally don't like buy gas, but another thing I like about this is the weekly chart is way better, but look at all these failed breakouts. So you have a failed breakout right here. I'd say this was a failed breakout, fell back into a base. Third failed breakout, fell back into another base. Now you're in your fourth consolidation. So when someone is trying to buy traditional breakouts and they just get stopped out after stopped out after stopped out, classic shakeout right here, if you know what I'm talking about. But if you're getting stopped out, like the more you get stopped out, the more failed breakouts, the bigger the move it is going to be when it works, right? And now you have a fourth attempt at this, and there is a screaming rising relative strength line in the middle of a correction, breaking out of a cup with handle on huge earnings volume. Something to pay attention to. And if you look at the weekly chart, it sure, this kind of looks like looks like a weekly reversal pattern, although it reversed above all the previous weeks, but it undercut them too. So this is something worth researching.